All right, so those were the top headlines that we're tracking for you at this hour. And let's talk about Rupee. The already battered Rupee's wild moves on Monday reflected multiple bets in favor and against the Indian currency. The questions have now come to fore as who is actually making money out of Rupee's misery. After surging as much as 1.4% to 92.9 per dollar at the Monday open from a low of 94.8 per dollar on Friday, the rupee gave up gains and hit a fresh low in the final stretches of trading. The currency crashed to a record new low of 95.6 before closing out of the session just above 95 per dollar. Now, these wild gyrations come despite measures announced by the Reserve Bank of India, India's central bank, announced a daily currency position limit of $100 million for domestic banks. That move was aimed at reining in speculations, betting on a further fall in the rupee. However, the impact of RBI's measures was short-lived as war fears triggered panic selling. The rupee's reversal shows that the currency weakness is deeply structural due to elevated oil prices. Crude importers rushing to buy dollars also hurt the rupee. Bets are that the trade deficit will widen further for import-dependent country. Now, in addition, the crash in Indian stocks is adding to the currency's woes. Now, foreign institutional investors have orchestrated a record exodus from domestic stocks, and they have withdrawn over $12 billion in March alone. The latest carnage has surpassed the previous record of 94,000 crore rupees, or a touch more than $10 billion, pulled out in October 2024. The record sell-off comes due to an escalating Gulf conflict, which has driven crude prices to above $116 a barrel from about $70 before the war. The rupee has taken the biggest hit from the Iran war in its fifth week, falling repeatedly to record lows through the month. That has now triggered market downgrades and concerns about India's growth outlook. And for more on this, we are now being joined by Amit Pabri, the founder and MD of CR Forex, live from Mumbai. Hi Amit, welcome to the show. Thank you for joining us today. Now let's first talk about the rupee and the RBI measures that have recently come into play. Now, why do you think the Reserve Bank of India took this step? Was it mainly to curb speculation or to actually support the rupee?
I think they've taken the step for both the purposes, to curb the speculation and to control the volatility in the rupee.
Right. And now, given against the backdrop of these measures, do you think limiting banks' position that increases the risk of higher volatility in US dollar and INR going forward? What are your thoughts over there?
So basically, I think this is a nice step taken by the RBI, that when the volatility is at a higher level, when the rupee is getting weaker, they have intervened and given a strong signal that main hona, or you can say a Dhurandhar kind of a move. So basically, in the short term, we are expecting that as banks are going to unwind close to $15 to $20 billion on the long side,
right,
immediate reaction will be that rupee might move towards 92.5 kind of a level. In case if the war settles, then the pressure can be more, and probably we can get a move towards 92 also. Now, we have to divide the rule into two aspects. In the short term, it is positive. In the long term, what will create is that offshore market will again determine the value of rupee, and there will be higher chances of gap up and gap down in dollar rupee pair. But saying that, current scenario needs RBI to proactively manage the volatility today. In case if things settles, they can always go back to the old rule.
Right. So given the current scenario, it's necessary for the RBI to proactively manage the slide in rupee that we are seeing. And, speaking specifically of the rupee, you've already said that in a short term, it's going to be a good thing as far as the RBI's forex cap move is concerned. But what's the outlook for the rupee after it hit another low on Monday? What are some of the levels that you're looking at?
So basically, we are expecting that 95 to 95.20 is going to act as a very strong resistance in the near term, and a move towards 93.5, 92.5 is likely in the very, very short and medium term. If the war continues, if FII outflow continues, then there will be a pressure near 92 and a half or 93 kind of a level. But in the short term, the biasness is that we are moving on a stronger side.
All right, so moving towards those levels. But Amit, lastly, before we let you go, this forex cap move from the RBI is the latest one to come in. But if the war prolongs, do you think more such measures will be needed, or do you think this is enough for now?
RBI has been very actively managing the volatility in the forex market. If the war continues, they have other tools like FCNR, increasing interest rate in FCNR, and increasing the interest rate. So there are other tools also which they can come and introduce so that they can curb the volatility in the rupee.
All right, thanks, Amit, for sharing that perspective with us. On that note, we'll let you go.
Thank you.